Good morning again. I have the pleasure of moderating our first general session of P3 2022 on behalf of Kiewit as the session sponsor. Kiewit is one of North America's largest and most respected construction and engineering organizations. Its construction and design engineering professionals work on some of the industry's most complex, challenging, and rewarding projects, whether it's boring tunnels through mountains, turning rivers into energy, or building bridges that connect communities. It's also an active and innovative member of the P3 sector. Some of Kiewit's most notable P3 projects across Canada include the Sea to Sky Highway in British Columbia, the Autoroute A25 in Montreal, and the Clecho All-Season Road in the Northwest Territories. In today's panel, we'll discuss whether Canada can continue to seize the day and bring a slew of much-needed nation-building projects to the finish line. Governments across the country have promised tens of billions in historic investments in infrastructure, from building mega hospitals and new highways to once-in-a-lifetime irrigation, transit, and power generation and transmission projects, to providing safe drinking water and modern wastewater systems. The desire to tackle our significant infrastructure gaps and achieve ambitious climate targets is commendable, but we know there are some current challenges in the market. Our panel will discuss both the opportunities and the challenges and have some direct and perhaps provocative suggestions how we can rise above these issues to create a more vibrant, resilient, and innovative country that provides greater opportunities and a better, more sustainable way of life for Canadians. So now I'd like to welcome our panelist to the stage. Sam Chai, President of Kiewit Development. Sam leads a cross-border team of investment and development professionals in North America focused on landmark projects across a broad range of energy and infrastructure sectors. He's also a dedicated member of the Canadian Council's Board of Directors and Executive Committee. Sharon Tellem, Managing Director, Debt Capital Markets, Scotiabank. Sharon is responsible for structuring and executing P3 corporate and project finance in Canada. She's been instrumental in the underwriting of P3 projects totaling more than $15 billion of debt. And our third panelist, Phil Verster, CEO and President of Metrolinx. Phil oversees a team committed to transforming transportation in the Greater Golden Horseshoe area. Prior to joining Metrolinx, he managed train operations, infrastructure builds, and infrastructure management for passenger rail systems in England, Scotland, and Ireland. Now, before we get into what promises to be a very animated discussion today, I have just one important piece of housekeeping. If you'd like to ask questions of our panelists today, you can do so by using the P3 2022 app. Some of you will have that already. For those who don't, the way to get it is to download the app from the Apple Store or the Google Play Store. Just search for P3 2022. And thank you to TIPSA for sponsoring the app. Once you have the app, the way to submit your question is to search for this panel and hit the comments button, enter your question, and a moderator will get it up on the screen so we can see it. Okay, so now I'm going to sit and join the panel down in the armchairs. Welcome, everybody. So thanks again to Kiewit for sponsoring the session. I mean, we have three excellent panelists here. We've had a couple of animated discussions leading up to this. But we've been promising throughout some fierce conversations, some candid observations, and let's talk about the real meat of what's going right and what's going wrong. But the title of the session is almost a question or a taunt. Can we still build big as if we can't? I mean, we've been doing a lot of great things, and although there are some challenges in the market, it's not all plague, pestilence, and famine out there. There's some good things going on as well. So let's start with what's been working well, what should be preserved and harnessed, and what do we need to be using as our foundations to build upon. And I'll start with Phil.
Yeah, of course we can build big. There's no question about that. The real question, I think, is about how we deal with complexity and risk allocation. But look, there's so much going well. We've recently closed, and it's public now, on two of the big three packages on Ontario Line, which would be the biggest transit project in North America. We had three competitive bids on each of those two packages. And on the third package, we're in the North Civils package. We've broken that into even smaller packages to get market appetite and market competitiveness captured. And we're very excited about that. We've got a $75 billion transit capital program over the next 10 years, and we're nearly halfway through the procurement. But for sure, these are times of upheaval and challenge, and so it's necessary to adapt. It's necessary to think carefully, and I think it's important that we set up that value chain, that way of working right from the owner level through down to into the supply chain. But we can do this.
So, Phil, I mean, I know you've had your experience here in Canada as well as various other jurisdictions. I mean, is what we're seeing right now part of a cycle? Is this just a normal factor in the market, or is this an unprecedented?
Nothing of what we're seeing is normal. How likely did we think it was ever going to be that at CO level meetings we'll talk about availability of cement? Yeah, commodities that we've taken for granted ain't for granted anymore. Our supply chain has challenges, deal with difficult issues, and the world is struggling. In a post-COVID world with wars in Europe, supply chains and COVID restrictions in China, seen huge impacts, sometimes small items with big consequences. The world is in upheaval. Very little of what we see is normal.
Okay, challenges ahead. Sharon, let's turn to you. What's been going well?
Yeah, I think from a financing perspective, and I'm in debt capital markets, so I kind of view the world from a financing and bond perspective, there's a lot to celebrate. When I look at kind of where the market's gone from kind of pre-2010, there were a handful of bond investors looking at the bond market, like basically the life insurance companies, to today there are 50, 60 plus investors that are following the market. We've done 23 billion of bonds since then, and that's just a fraction of the private capital that's gone into projects. That doesn't include bank loans, doesn't include deals that are done, kind of directly with investors outside the capital markets. So it's probably more like 100 billion. Probably somebody has the number, but it's a staggering amount of private capital that's gone into P3s. Other successes, you were mentioning the Ontario Line projects, like despite the fact that market conditions are tough and some corporations are having difficulty raising debt right now, we're still able to finance P3s throughout any market conditions, beginning of COVID, when there was a lot of uncertainty. Now when we're nearing potentially a recession and there's uncertainty, deals are still getting done. And then the last point I'd make is things haven't always gone great. There have been projects that have been very delayed or way over budget. Contractors have defaulted and had to be replaced, and yet bondholders continue to get paid. So that tells me that the P3 model is working. The people that are supposed to be taking the risk are taking the risk, and it's a resilient model that makes sense. So lots to celebrate.
That's great. Sam, how about you? What do you see as the highlights?
Yeah, I mean, to the question first, I absolutely think we can still build big, right? And I've been reflecting on the council's 30 years and thinking about all of the thousands of hospital beds and, thousands of kilometres of rail and road that this industry has built across Canada under the P3 model. I sort of think about those very early projects like the Confederation Bridge or some of the earlier Kiewit projects like the Sea to Sky Highway and the A25 bridge that you mentioned. And I try and put myself in their shoes, at that time, the people that were negotiating those deals, they weren't bogged down by precedent yet, right? 15, 20, 25 years ago, they were really trying to find ways to harness the power of the P3 model, really coming together with, owners and contractors and operators and financiers really trying to understand how to innovate and what this model meant. We've seen the benefit of what we created. I think if we can get back to that spirit of partnership, we keep talking about that spirit of partnership, that third P, and really collaborate meaningfully, I think we'll be really surprised at what we can do going forward.
Okay, very good. So let's move on to the second one, which is kind of the where the market is often talking about what says the current challenges in the market. And when we were preparing for this, I brought out one of my acronyms and learned a new one from Sam. So the first one is EGAP, which is the World Bank's acronym for Everything Goes According to Plan, which is their view of the optimism bias that is built into most project structuring. Assume there will be
Can I just say, Mark,
no challenges.
In Metrolinx, we rarely use that acronym.
Or if you use it, you'll be disappointed. Yeah. And the alternative, so if that's utopia, the dystopian model, courtesy of Sam, is VUCA. Volatility, uncertainty, complexity, and ambiguity, which maybe sounds a little bit more like today's context. But there's always some good and some bad in every market and every moment in time. So let's get into it. What are the challenges today, and are we sitting more towards the EGAP? Probably not, Phil, or more towards the VUCA end of the market. Sam, I'll start with you.
Yeah, I absolutely think we're sitting more on the VUCA side of things. That's very subjective, of course. But I think there are really two challenges that I wanted to raise today. The first, we've talked about a bit here around inflation, price increases, the availability of supply, as Phil mentioned, things that you just took for granted. We've enjoyed globalization for so long. It's just worked so well. But now we're really seeing how fragile that can be. Pre-COVID, we spent a lot of time talking about the infrastructure deficit in Canada, right? And really, there was this conversation around supply and demand. There was more demand for projects. We needed more projects. There was supply sort of inherent in the market. And I think that dynamic has flipped coming out of COVID now. There is just so much money in the system, both from public and private sectors, that demand is just far outstripping supply, which is causing those price increases, and then they're just further exacerbated by the unavailability of some materials. So I think as we look forward, we need to think about how we're going to address those challenges. It's very difficult to price anything today, let alone for 2 or 3 years out, let alone in the operator space for decades into the future. And I think we need to have an honest conversation around how effective that risk transfer is going to be, sort of looking at fixed prices across an entire project. When I first joined Kiewit about a decade ago, the distinction between an estimate and the cost was rammed home to me very quickly, right? At bid time, you submit an estimate because you only ever know the cost of a project once you're completely finished, right? And I think that now, more than ever, is really resonating with me. We don't know what things cost today. You can only estimate what it's going to cost you today. And I think there are challenges in current projects where the estimate was developed years ago, which is clearly out of date, and even for projects that we're thinking about going forward, right? The estimate or the cost forecast you write down today is out of date the moment the ink is dry, right? And so we need to come together to address that challenge of price increases and escalation. The second point I wanted to raise was around mega jobs, right? There's this natural tendency to bundling. There is a lot more to do. The infrastructure deficit didn't go away. We need to accelerate our nation building. But mega jobs introduce a whole nother set of risks that we need to be talking about, sort of enterprise risks, where one job can take down your entire company, right? And I think if we're having those conversations, perhaps the risk transfer is maybe a little skewed, right? Because I don't think that's an effective allocation for either party on the owner side or the private side, where one job can take down an entity. It's also driving some interesting dynamics, I think, in terms of competition, right? These mega jobs require you to come together, right? Where in the past you could tackle a $500 million job, no problem. If you're looking at a $2+ billion job, you're forced to partner, whether you want to or not, right? And so that's going to naturally reduce competition. So I think we need to be thinking about how we address the unique dynamics of mega jobs. And escalation. The final point I want to make was that I was at a presentation recently, and I think it was FMI has had espoused a view that the volume of mega jobs on an annual basis is expected to increase by 600% over the next 10 years. So 6 times as many mega jobs on an annual basis over the next 10 years. And I think that's staggering. And if that does come to fruition, we need to address these challenges with mega jobs today.
And sure, Phil, let's go on. One of your challenges, I'm sure that's not the end of the list.
Yeah, no, I think it's interesting, Sam, picking up on the enterprise risk level decisions that organizations in our supply chain must make. And I think what is evident in a world where we have inflation, increasing project costs, increasing challenges within that supply chain, which attracts risk premiums, the whole approach to what partnership really means has to change. And I think the industry and people in this room is aware that the shift towards progressive design build, progressive models, target pricing rather than fixed price at bid, target price at bid, target price after development phase, Sam's point on understanding truly what your risk allocation, your risk transfer is, this is a must. Now that's still a partnership. I would say that's by far more of a partnership. And if I look at what we've done with our alliance model in the Union Station Enhancement Project, with Kiewit, WSP, and Aberici, phenomenal how these models can actually help you to deliver better. And Lisa was right in a keynote address earlier. No model is the solution to all ills. Every model has got its challenges, and that's what we need to adapt to. But I'll share with you one of the concerns I have is really whether we have in our local industry leadership, enough skills to actually deliver the scale of the programs we've got. People in this room are essential to our programs, but we need more. And there's a scarcity internationally and globally. There's a scarcity in resources, scarcity in leadership, scarcity in experienced leadership. And that affects the quality of decisions that are made at the top end of projects. And I think that's very real for us as an industry. We have to figure this one out about how we attract more big-hitting leaders into the industry.
And Phil, you mentioned in our prep session some of the hurdles you're coming up against and developments you're making in terms of community engagement. So you have that sort of multi-headed Hydra engagement problem. Can you talk a little bit about how that's been going?
You know, sometimes in these conferences, I was thinking on my way in this morning, we talk about our projects and infrastructure projects as if it's an infrastructure project, as if it's like building a roadway or highway somewhere, as if it's a freestanding piece of infrastructure, and we think of it like that. If it's a water plant, purification plant, it's like a fixed asset. But you think of transit. Transit is about how communities are starting to live. It's sort of part of the fabric of how community operates. And when we have these big projects in developed cities, there's a huge impact on the local community. I sometimes refer to it as doing open heart surgery while you're running a marathon. It's really difficult. Yeah. And what complicates things sometimes is the fact that we live in an interesting world where facts doesn't always seem to survive. There are different alternative sets of facts sometimes available. Communities are sometimes exposed to campaigns where, I'll give you an example. We've listened very carefully to our communities in Leslieville and Riverside, and clearly they felt many things about us, how we're going to build the Ontario line and through that at-grade section. But for a long period of time, there were suggestions that we were going to make parks smaller. While we listened to the community and adjusted our construction method, and we're making all the parks bigger. But facts struggle to survive in the world we're in, and all that means is that organizations such as ours need to do more, continuously be innovative, come with more ideas on how to reach out to communities, how to listen better, how to hear what communities are saying. And this is part of big projects as well. Big projects are not only about the contract form, the model, the delivery, or the economic benefits. It's really about how communities experience what you do while you build it.
Great. Okay, Sharon, over to you. What are the stresses in the market right now?
I think we're definitely towards the VUCA side of things. Certainly a lot of volatility we're seeing in capital markets. One factor that hasn't been touched on is interest rates. I think everyone's aware that interest rates have been increasing and are continuing to increase. So they're up about 300 basis points or 3% from their trough in about July 2020. So that's a very material increase. Credit spreads, not as bad, but they're up about 40 to 50 basis points. So the cumulative increase for a P3 project is something like 350 basis points. add that to much higher construction costs, and this just compounds the issue of making projects less affordable. And we have seen projects be canceled due to unaffordability, which is really disappointing when you work on something for a long time and it gets canceled. And interest rates, we've seen days where they move 20, 30 basis points in a day. So if you're trying to come up with a capital structure for a P3 project, it's pretty hard to decide, do you want your short-term debt to be bank or bond? Things are moving around on a daily basis, and it's really hard to make a decision on that. We're seeing the same thing with corporate issuers. They're standing by, not sure, should they come to market now? Are things going to get worse from here? Are we going to be in a recession and then interest rates go down? Maybe we should wait for that. Or maybe there'll be a recession, but spreads will blow out. Nobody really knows. So everyone's kind of frozen and not sure how to proceed. The other point, I just wanted to build on what Sam and Phil said. All of those factors also impact us as lenders or bond underwriters. When we're scrutinizing a project, we're looking at inflation risk. We're talking to the lender's technical advisor, making sure, is there enough contingency in the budget for what if inflation's worse than we thought? Have they budgeted enough? Is there enough buffer in the budget in the schedule if there are labor shortages or supply chain issues? What are the mitigants? So we're scrutinizing all of that. And we are in a higher risk period, and higher risk means higher credit spreads. So that's part of why spreads are higher. Yeah.
So what
Tough times.
What about capacity, Sharon? I mean, Sam says we're in for a huge rise in mega projects. Are we capital capacity constrained at all?
I don't think we're capital constrained. I don't want to give away too much of my next question, but I would say right now you could do a $1.5 to $2 billion financing in Canadian dollars, just focused on Canadian with some U.S. investors. So that's pretty large. We'd like to see that be bigger, but so far it hasn't been an obstacle. We're nowhere near satiating investor demand in this space. There were years where we were doing 4 or 5 billion in a given year. Now it's like maybe $1 billion a year. So investors would like to see more P3 supply, and I'm not at all concerned that we're running out of demand at this rate.
Okay, so that sort of view of the market, lots of capability, some challenges in getting projects done, and some demand to do even more, sort of leads us to what are we going to do with our scarce resources? What are we going to pursue, and how are we going to get it done? And that, I think, will be the meaty part of this discussion. But let's start with, what should we pursue? Let's assume we don't have the fiscal firepower or the industry capacity to do everything. What should the priorities be? Sharon, we'll start with you.
Sure. So again, putting kind of my investor hat, what they would like to see built, the two things they focus on are criticality of a project, and secondly, does it have an ESG, environmental, social governance kind of component to it? So in terms of criticality, they want to know that a project, that everyone's committed to getting this project done, that governments are going to do what it takes to get to completion, and that they'll ultimately get paid. So my personal view of what that would be, living in Toronto, is I think, transit is a top priority. Kids are back in school. People are coming to work. I was just talking about this at breakfast. It's coming from 3 days to 4 days to 5 days very quickly. We've got great, huge immigration targets that a lot of new people are going to be coming to Toronto, and we need to solve the traffic and transit issues. So I think that's a big priority in terms of critical infrastructure that investors would be keen to participate in. From the ESG component, I think social projects, there haven't been that much in the bond market. So things like clean water, affordable housing, long-term care would be super well received by investors. And then on the environmental side, I think transit qualifies as environmental in terms of it's getting cars off the road. So that's, a green initiative. It can also relate to things like hospitals, courthouses, any building that's LEED certified would be considered a green building, and that would be something investors are really keen to participate in. There's also Ontario's procuring 4,000 megawatts of new energy, so that's great. And the reason I'm bringing it up is part of that is battery storage, which is a relatively new asset class. There hasn't really been a standalone battery storage deal done to date, and we've had a lot of discussions with investors. They're super excited to participate in the first battery storage deal. So I'm bringing that up because I think the point is investors are open to new structures, new asset classes that they haven't participated in before, and Canada can be innovative, and the financing is there.
Okay. Sam, what do you think? Where should our priorities be?
I'm all about connectivity. I'd like to see more projects connecting people virtually, but most importantly, sort of physically, right? Coming out of COVID, I think we realized how important it is to have redundancy and security around our broadband and internet services. I think there's huge opportunities there. On our Talicho all-season road project, having had the pleasure of traveling that road now at minus 30 Celsius, to the community and realizing that they didn't have any Wi-Fi, right, or reliable Wi-Fi, just blew me away that there are still many communities in Canada without reliable, secure internet. And so we were actually able to work with all levels of government on that project as we were delivering the job to actually lay 100 kilometers of backbone fiber alongside. And I just wish that was sort of part of the project to start, right? You have this opportunity where you're already in the corridor, an opportunity to do something really special. So, I'd like to see more broadband type projects. And then on the physical side, sort of transportation and logistics, right? I think there's a huge opportunity in Canada for cargo around air cargo and then the seaports as well, to shore up some of that supply chain sort of challenges that we've been seeing in the market.
Okay. So we use a measure called the benefit cost ratio, which is just the transit benefits from a transit project. So that's just journey time savings mostly, it's about 85% of it's about journey time savings and connectivity for people that use the transit system. And it doesn't include the secondary benefits from stimulated development and infrastructure that gets built around a transit. Look at how Eglinton is going to transform itself, and it's already doing that. Every LRT and Ontario line is going to see the same. The benefit cost ratio for our GO expansion project is upwards of 2.6. That means for every dollar invested in that project, the economic benefits estimated over a 60-year discounted net present value to today is $2.6. We stop at 60 years because beyond 60 years, your discounting becomes infinitesimally small, but the asset infrastructure we put in is going to be in for 200, 300 years. Ontario line is just over 1 because it's per kilometer more expensive to build underground, clearly, and stations and the like. So, when you think about what needs to be prioritized, I think you probably need to ask a slightly different question as well. What's the cost of not doing stuff? And if you have a business model, if you have a business case that is predicated on a 60-year business case time horizon, and you're building an asset for 200 or 300 years, I don't want to make light of it, but how should you think about the inflation you're experiencing at this point in time, when it's going to be an asset that's going to be there literally for more than 100 years, and is going to affect literally how the economics of the region operates. So I think these are difficult choices, and it's all about what is affordable and what our shareholder, the government, can afford to do, and those are very big, important decisions. But it seems pretty clear that we should be putting infrastructure in place that makes our economy work and makes it work into the future.
Okay, good answer. So let's turn then to how to go about it. So we see some of the challenges, some of the opportunities, some of the imperatives. Sam, you talked about, yesterday we didn't have precedents, so we kind of made things up to, cut the cloth to suit what we had at the time. Today we have a different circumstance. How do we go about it? Do we need to start fresh, think fresh? Do the old principles still work? What do we need to do? So, Phil, we'll start with you because you're kind of on a roll already on the keep going. What do we need to do?
Well, I think project selection is crucial. You got to understand which projects will be transformative, and you have to have that longer future timeline in mind. Then after that, I think it's simple. Head down and get it done. That's important. Get it done. We have to push through the time frame we are in. It's challenging. We have to work with the supply chain and figure out what's the best ways to get market participation, get that risk transfer right, so that we have everyone being successful from the project, and make it a true partnership. And maybe I'll just say that sometimes a contract form can take away from how the partnership works. And I think we've all seen that. Contract forms can be constraining in terms of how you exercise a partnership and how you make a partnership work. And so while I'm pretty bullish about identifying projects and delivering it, I'm very sensitive to the fact that the way we do things in a tumultuous world as we're living in now, it has to reflect some of those give and take flexibilities that's necessary and which we have in our progressive design build model. And so this is a time for just pushing forward with stuff, but doing it with a real sensitivity to how the supply chain works and how our partners work with us.
Mm-hmm. So interesting. I'm just back from London a few weeks ago, and of course they have a fantastic transit network. And it occurred to me, I wish we had this. How can we get something like this? And the answer isn't think about it for another 10 years or do a royal commission and get going in 30.
I think that's
now.
Mark. I think that's really the point. You know, in Toronto especially, one can see how investments that could have been done many years ago systematically, it doesn't all have to be in a big spurt as we do now, but what we're doing now, I think is essential to try and catch up on years before where not enough investment were made. But it can't work like this for more than a decade. I think we need to get into a rhythm whereby there's just continuous accumulation of infrastructure that's getting built year after year in a systemic and systematic manner. I think that's really important. Stop-start with peaks and troughs is not ideal. But the commitment we have now to build this fantastic portfolio of infrastructure, I think is going to serve the region super well in generations to come.
Great. So Sharon, over to you. What should we be doing to liven up our market?
I think to build big, we need to access international capital. So I mentioned that the Canadian market capacity is about 1.5 billion. We've been able to tap into some U.S. investment, and I'd say it's about 500 million. We can increase that to 2 billion plus of U.S. investment. U.S. life insurance companies, et cetera, can invest in Canadian dollar projects. They want to invest in Canadian dollar projects, but they need to then swap those funds into US dollars. Their concern is if a project is terminated sometime in the middle, they don't get they have to then break their swap. They can lose an unknown amount of money. They can't really quantify it in advance, and there's no protection for that. So they've asked multiple times, we'd love to participate, but we need the compensation on termination regime in the project agreement to include swap breakage protection or indemnify U.S. investors for their swap breakage. I mean, Canadian lenders or any kind of lender that does a floating to fixed swap related to a P3 is indemnified for that. Bondholders are made whole. So this would just be an additional kind of ask. It's come up, but it hasn't been resolved yet. But if we want to do a $2.5 billion bond, we absolutely can, but we're going to need that protection for U.S. investors. So I think that's one thing we can do. It's also just having that makes a $1 billion bond a little more, the pricing can be better because now you've got a market of 3.5 billion instead of a market of 1.5 billion. So just the sheer competition of having a larger market should drive credit spreads in. So I think that's one tool we could be using. Another kind of thought I had, and it's not going to work for all projects, but almost every project agreement is 30 years. So we could look at doing 40-year project agreements. The reason I raise that is the life insurance companies that are the large investors in P3s love duration, would love to participate in a 40-year. The Government of Canada yield curve is totally flat in that part. So, there might be 5 or 10 basis points of credit spread to go from 30 years to 40 years, but the cost is basically the same. So I think the benefit there is you can spread a construction cost over 40 years rather than 30 years. Other than that, other tools, talked about splitting projects into smaller sizes. That makes sense. There have been government guaranteed deals. That's a tool that can be used. CIB's been involved in doing, subordinated debt, things like that. So there are a lot of tools in the toolbox to build kind of any infrastructure that we want.
Good. Sam, what do you think?
Yeah, I mean, I don't think the challenges are insurmountable, right? But I think it's going to take courage, right, and commitment. So to Phil's early point, we just got to get going, right? We know that the prices are volatile today. We know that interest rates are up, but over the life of a 200-year tunnel, what does that matter, right? We just need to figure out how to work through those challenges today and get going, right? I say courage because I'm coming back to this precedent piece. We need to have the courage to break and modify and innovate the precedents that we've developed. What happened, in the search for efficiency, right? Precedent. Being proud of ourselves for doing 30 deals in a year, right? That drive for efficiency just destroyed innovation in the model, right? And I come back to what do we need to do? We need to sit down today. It is not the environment we were in, 5 or 10 years ago where we just said precedent, right? You didn't even negotiate the contract. All you heard was precedent, right? That was fine then in an EGAP environment, but we're in a VUCA world today. We need to sit down and work through these challenges that we see, and we have to have the courage to break with precedent. That's my first point. My second point is, listening to Sharon here. Sharon's got great ideas from the financing markets, but when did the F in a DBFM become silent? Right? Why is it that contractors and owners are out there talking and battling on these points? Where is the value in the finance? Right? And I'm a huge proponent of P3. I think it unlocks, the best of every part of the market. But I think the challenges we're seeing today are shining a light, in my mind, this may be controversial, on perhaps the lack of value that finance has been bringing over the last decade, right? Where is finance? Where is the debt? Where is the equity? Where is their ability to take risk? Where are they at the table when we're talking about 9-figure losses on construction jobs? But I can barely find 5 examples of equity returns that have suffered any loss or bondholders that have suffered loss. And I'm not saying this is it's not who can lose more money, right? That's not the conversation today, right? But it's everyone needs to come together, right? And I put the challenge out there to all the financiers in the room to think about from an investor perspective, either debt or equity. What are you doing to help us solve these challenges? There is an F in DBFM, right? It's not just up to the contractors and owners to solve this problem. You need to bring ideas to the table, and I think when we all come together, we will find those solutions.
Okay. I promised you'd be provocative, and you are.
There you go. They got me fired up. Yeah.
So let's challenge that a little bit, because Phil has become an advocate of alliances, like a non. And I don't think you're allergic to private capital, but you've seen some benefits of alliances, which don't include private capital. Sam, you would like private capital to have a role. I mean, what's the right model? Are we in a mix and match environment, or is it choose A or B?
We're definitely in a mix and match environment. When we talk about the role of private capital in our projects, I prefer to take it a step back and go back to the level of what type of complexity are we dealing with, because talking about P3s feels like a very generic conversation, while the innate risk profile within a project is the make or break of a project. And if you look at what we have done with our packaging strategy, is do we really want our supply chain, where our supply chain will excel in civil construction, to also bear the risk on intricate signaling systems or building trains? Or is it better to separate some of these systems out and some of the package of the project out, and inherently have risk take back at the owner level, which brings its own challenges in terms of how do we set up our own projects delivery structure and our own teams, and how do we become more muscular in managing some of the interfaces, which is which is an interesting question, because if you want to manage the interfaces, what's the contract form so that you don't overstep into the contract form line where risk has been transferred and you're in effect trying to solve risk that you've transferred. So these choices are really crucial, difficult choices that we must make up front, and which we are making up front, and which we very clearly signal to the market that that level of risk transfer discussion is open for discussion, and we're doing it. But if I take Eglinton Crosstown West extension, during COVID, we went to market with the tunneling contract on the Eglinton Crosstown West extension, and in a absolute record time from the RFP hitting the market to having the contractor on site, which was just over a year. Work started on site. It's a DBF contract, P3 contract. Structure is perfect for that risk transfer in that project. And our partner there is delivering a fantastic tunneling contract, and it's moving at speed. So I don't think there's one formula that works in all cases. I think there are different formulas. And when complexity goes up exponentially, and you take our Union Station Enhancement Project, which is at the hub of the city, right at Union Station, at the hub of our operations. So there are permit risks, there are multiple property and real estate risks, there are interface issues with multiple entities around Union Station as well as in Union Station. In a world like that, you need a different model, something that is not, you're not in a prescriptive producing cans of soup type of model where you have, and I'm being disrespectful towards other contracts, I apologize, but it's, there's this saying, if you've done one transit project, you have done one transit project, so because every transit project is different. And it's when you're in that level of complexity and risk profile, there's not a generic formula that works for that. And you need degrees of freedom in how you deliver that. And a progressive model gives more degrees of freedom.
Okay, so I see we have a couple of questions coming up, so I'm going to save some time for that. Sam, you'll have a rebuttal about the importance of private capital, I'm sure. But let's go to sort of final comments and provocative ideas, not that we haven't had any already, that you want to leave with the audience. Phil, what do you say are the takeaways? What are the big messages you'd like to leave behind?
Big messages for us are partnerships, everything for success. Partnerships, everything. We cannot deliver our programs without the partnership of organizations that are represented in this room. And we learn and we adjust, and we are not always going to be fully aligned on all aspects of how a project gets delivered, how it gets bid, and how it gets completed. However, we're partners, and so we will always find ways forward. We'll always find a way to turn this into success. And success is not necessarily on one project only. Success is on 10, 15 years of consistent delivery. And we are eternally grateful for the contracting community that's in this room, as well as the finance community in this room, and the design community in this room, everyone that contributes to our projects, whether P3 or other partnership contracts. That's key for us.
Great. Sharon,
Yeah, I got to touch on the private capital. I mean, I think private capital has an important role to play in the P3 model. I think it's the kind of the glue that makes sure, like I was referring to the due diligence that we do, I think that kind of benefits the contracting authority. Like we ensure that this thing is rock solid from every perspective, and it's our capital at risk ultimately, right? And it will be paid back through government funds, but if it doesn't get built, it's a combination of the contractor and the bonds and equity that are at risk initially. So I think it's an important component. I do think the progressive model makes sense in some cases, still with private capital at some point from Scotia. Anyway. So final thoughts. I mean, I've touched on this a lot. I want to make the point that there's lots of capacity. Canadian investors love this space. They want to see more projects. They want to see DBFMs, and there's really, we haven't come near exhausting the amount of private capital that's available. And then sort of off topic, not really my area to comment on this, but I do, when I just kind of stand back and look at infrastructure in Canada and what's being built, my wish for infrastructure would be that municipal, provincial, federal, all the entities come together, make a list of everything that needs to be done, collaborate, prioritize, and figure out what are the top priorities, because all these organizations are building things, and then there's still people without clean water. So that would be kind of my my wish for the infrastructure genie.
Okay. Sam.
Well, you said final thought or provocative thoughts. I'm going to go with the latter because you got me going. But I'm going to come back. You did. You got me going on the equity piece. When did we lose our way in the role for equity in P3s here in Canada? Right? When did equity stop being the highest risk, highest reward piece of the capital stack? Right? I think that we've missed something along the way. Right? We've so highly structured and highly levered our projects that equity has been relegated to a 3-person mailbox. And even if the fantastic men and women that are working in our SPVs, right, had the ability and the time to go and run at these issues, they just can't, right? They're just too tightly and highly structured to allow for equity to add material, real significant value in working through the risks that we see in the market. So again, I just want to challenge everybody in the room, at the risk of getting beat up over drinks, to go and think about, you as a developer, what are you doing to help solve this problem? In other sectors, in other countries, in other jurisdictions, and even in other markets here in Canada, equity takes more risk, right? And we don't need to keep falling back depressed and, well, I didn't have to. I earned my high teens return on an availability deal. It's just like a mortgage. Look how great I am. Look how happy my investors are. Well, look how sad everyone else is, right? What are you going to do to bring value back to this market? I think you need to be at the table alongside everybody else and solving the problems that we see, the challenges that we face. And I think there are huge opportunities. You could deploy more capital, right? If you were willing to take a little bit more risk. I think that's my final provocative thought, Mark.
Okay, you hit the mark for provocative. Good for you. A couple of questions are coming up here. First one's for Phil. Do you see the need for Metrolinx and IO to become more accommodative or flexible for interface issues for something like Ontario Line compared to Eglinton? Referred to as a legacy project. I'm not sure we can call it legacy.
So from the moment that question came up, I've been looking at the two words that are interface issues. Mm-hmm. Isn't there a lot of wisdom wrapped up into those two words? There's different ways of looking at what interface issues are. We have vastly increased the number of interface issues on the Ontario line. Depends on what interface issues you're talking about. But we've taken an integrated transit project and we've divided it into 3. And now we're going to take the third package and we're going to divide that into at least 4 different bits. So there's lots of interface issues to manage. And so we've adopted, obviously, a different team structure on our side with a delivery partner that's going to be fully integrated as in an alliance-type partnership with us to deliver that and to help our P3 contractors and our non-P3 contractors all to deliver a final project. It is a phenomenal task. And the interface issues are going to be what we're going to obsess about and relentlessly focus on in the coming years. So if I read the question again then and say, are we going to be flexible with interface issues? It sort of gets overshadowed by the question of what risk transfer do you adopt to make sure that risks are best managed? Interface issues that are low risk is not much of a worry to anyone. But we are definitely, as Metrolinx and IO, collaborating to create a whole contract delivery structure with contract packaging that makes the project more easy to deliver with a lower overall risk transfer to the supply chain. However, is the risk on the whole project slightly higher? For us, definitely it is. because that's the formula we have to adapt to and adopt for the current market we're in. So for definite, interface issues are up for discussion.
Great. One more question. Time for one more. We'll do the one at the bottom there. I think this is for you, Sam. There was a comment about large P3 projects requiring competition. The questioner assumes this is down to bonding capacity. You mentioned enterprise risk, but the question overall is, what do you suggest is the right approach to maintain competition in large projects?
Yeah, I don't have the perfect answer for this, but I think what Phil is talking about and the way that Metrolinx is approaching these mega jobs is really refreshing, right? It's looking at the underlying risks that Phil talked about and coming together in partnership to talk about how you're going to address them, because it's not one size fits all. And to the extent we keep on trying to ram down this fixed price DBFM into these models and saying that this is the way that Canada does it, we're just going to keep going around in circles. So, I think bonding capacity is legitimate. That's a real concern for sureties and the market, but there are ways that you can phase jobs, you can break them up as Phil has been doing. You can bundle them where they're still broken into independent pieces all within the one contract. So again, I just think we need to be coming together to talk about it, including the finance too, because the financing is core to this, right? In terms of phasing and how you may be able to pay down certain elements as you go. But I think if we talk about those, we can maintain the competition in these large projects. Absolutely.
Okay, great. Well, I promised you a candid conversation and provocative from panelists who are not afraid to rip off the Band-Aid and have a look. So I'd like to thank all the panelists. It was a tremendous session to start the day. Okay, next up, now we're about to head into our first networking breakout, sponsored by XCAP and Leo Berwick. So please, out the doors there, grab something to eat and start your networking. Be back here in 15 minutes for the next general session. Start me up, hopefully with the music. Canada's Energy Renaissance, sponsored by P1 Consulting. Thanks all.
Great. Thanks, Mark.
Thank you.